So the next thing that we need to model is our debt. So businesses from time to time will need to borrow money in order to expand their operations or buy new equipment. And they need to raise that funding from commercial banks or from retail banks from time to time. So how do we model the debt profile of a typical amortizing debt facility? Let's see. You'd have your opening balance. You'd have the amount of money that you draw under your debt facility in the year. You'd then have your interest charge. So in some facilities, the banks will allow you to capitalize that interest, meaning that in certain years, you won't necessarily need to pay the interest that you incur during that year. And you can just increase the amount of your loan by the amount of unpaid interest in that year. And you do that with the bank's permission, of course. So that's interest paid, just to allow for us to capitalize interest. And then capital paid. Okay, that's just your amounts, your installments to repay the actual capital amount of the debt. And then we have a closing balance. So let's use 2020 as our base here, and we can just pull that forward. Let's assume that this business is going to have a 5-year debt facility. So at the beginning of the year, we had 0 debt. But let's say we borrowed $100,000 in debt from a bank, so that money is coming in. Let's assume an interest rate of 5% per annum. So in that year, we borrowed $100,000 at the beginning of the year, and we're charged an interest cost of 5% on that debt. Okay. Now, let's assume that the business does not generate enough money in the first year to make any interest payments. So the bank allows the business to capitalize that interest into the debt facility. So we pay 0 interest, we pay 0 capital, and at the end of the year, the amount of debt that we owe to the bank is now $105,000. Let's look at the next year. So our opening balance is just the closing balance from the previous year. Let's say we need to borrow an additional $20,000 from the bank in order to complete whatever project we started the previous year. So our interest cost is we had $105,000 on our books and we added $20,000 in debt. So we're going to be charged interest on this $125,000 for the year, which gives us an interest charge for the year of $625,000. So let's assume that the business starts to generate enough cash to actually start paying its interest, not capital, but just interest. So we repay our interest burden for the year, but we can't afford to pay back any capital yet. So this gives us a closing balance of $125,000. So let's do the next year. Our opening balance will just be the closing balance of the previous year. We don't need to borrow any additional money. Let's see, our interest cost is just our opening balance multiplied by the 5%. Okay, same interest cost. We pay our interest for the year, but we also decide that, okay, it's time to start repaying the capital on this debt. And we can repay this capital in 3 equal annual installments. So we owe the bank $125,000, and we're going to say to the bank, okay, we're going to repay that over 3 years. So I'm just going to lock this cell because we're going to drag that across. Okay, and our closing balance is just the sum of all of that. So we've repaid our interest and we've repaid $41,666,000 in capital. So we now only owe the bank $83,000. So you can drag that formula across, and this is going to be 0, and it's going to be 0, 0 drawdowns. And we see that we've repaid the debt in 5 years according to this profile. So going back to your tax calculation, when you are reflecting the tax that you pay in any given year, you don't reflect the tax that the interest that you actually pay. You reflect the interest that you are incurring in that year for tax purposes. So that's just something to bear in mind, that there's a difference between the cash flow treatment and the tax and the accounting treatment when you are modeling your debt.